Good morning and welcome to the post-MPC press briefing by the Central Bank of Kenya. Today is Wednesday, the 11th of February 2026. The MPC met yesterday, Tuesday the 10th, and made its decision, which was communicated via press release. And today, as usual, we'll have the chairman of the Monetary Policy Committee, who's also the governor of the Central Bank, giving a briefing on the background to that decision. And you can then come in and ask your questions. If you would like to come in with your questions, please go to slido.com. That's slido.com. The meeting ID is MPC. That's hashtag MPC 0226. Please make sure that you ask your questions. As you ask your questions, you put in your name and your institution, and we may consolidate quite a number of questions in case they're asking the same thing, and if the question has already been answered within the presentation, you'll understand if we may not necessarily put it back because it will be a repetition. But anyway, I want to hand it over now to the chairman of the MPC, who's also the governor of the Central Bank of Kenya, Dr. Kamau Thugge.
So good morning, everyone. The Monetary Policy Committee met yesterday, February the 10th, 2026, and made the following decisions. They lowered the central bank rate by 25 basis points to 8.75% from 9%. It also further strengthened the effectiveness of the monetary policy implementation framework and to enhance the monetary policy transmission. The MPC approved the narrowing of the interest rate corridor around the central bank rate from the current plus or minus 75 basis points to plus or minus 50 basis points. The committee also adjusted the applicable interest rate on the discount window from the current 75 basis points above the CBR to 50 basis points, which is the upper bound of the interest rate corridor. The MPC observed that overall inflation is expected to remain below the midpoint of the target range in the near term, and that this will be supported by stable prices of processed food items and energy, and stability in the exchange rate. It also observed that central banks in the major economies have continued to ease monetary policy, but at a cautious and uneven pace depending on their inflation and growth outlooks. They also noted that the average lending rates in the domestic market have continued to decline, while private sector credit growth has continued to improve, though at a slower pace than is desirable. The committee therefore concluded that there was scope for a further easing of the monetary policy stance by reducing the CBR by 25 basis points. This will augment the previous policy actions, which were aimed at stimulating lending by banks to the private sector and supporting economic activity, while ensuring inflationary expectations remain firmly anchored and that the exchange rate also remains stable. The narrowing of the interest rate corridor in the monetary policy implementation framework will further support the alignment of the Kenya shilling overnight interbank average, KESONIA, to the policy rate, the CBR. And finally, the interest rate on the CBK discount window is set at the upper bound of the corridor to ensure that KESONIA remains within a predictable range. The MPC will closely monitor the impact of these policy decisions, as well as developments in the global and domestic economies, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in April of 2026. The committee started its deliberations by looking at global economic developments and outlook. The committee noted that global inflation declined in 2025 and is projected to decline further in 2026 and 2027, and this decline will be driven by lower energy prices and reduced global demand. And so inflation is expected to decelerate from 4.1% to 3.8%, and in 2027 to reduce further to 3.4%. Looking at inflation in some of our major trading partners and some of the major economies, overall inflation has eased modestly in the recent months, but is still above the target for some countries, reflecting the stickiness in core inflation. As you may know, the target for most of the major economies is to have inflation, headline inflation, below around or below 2%. And as you can see from the panel on the left-hand side, with headline inflation, that other than the Eurozone, whose inflation now is at 1.7 and therefore below the 2%, that for the US and the UK remain well above the 2%. And part of the reason for that is the right-hand side, that core inflation in those countries has remained relatively high, and therefore hindered the reduction in the overall headline inflation. In contrast, the international oil prices have declined on account of increased production and subdued global demand, but have been volatile mainly due to elevated global uncertainties. The OPEC plus producers have raised their oil output by about 2.9 million barrels per day in 2025, and in addition, the non-OPEC producers have also contributed to higher supply. The main risk to oil prices relate to volatility due to supply disruptions arising from escalation of geopolitical tensions, particularly the conflict in the Middle East as well as in Ukraine. Food inflation declined in January of 2026, partly driven by lower inflation rates for sugar and cereals prices. And as you can see, the global food inflation was minus 0.6 in January 2026, and this reflected the decline in sugar price inflation by 19.2%, and also the decline in the cereals price inflation by minus 3.9%. And in a sense, that offset the increase in edible oils prices inflation, which increased from 1.9% to 10.2%. Turning to global economic growth outlook, growth remained resilient in 2025, reflecting lower than expected effective tariff rates on U.S. imports. It also reflected improved financial conditions, strong consumer spending, and a surge in investment in artificial intelligence-led technology. The global growth for 2026 has been revised upwards, mainly due to the improved growth prospects in the US, the Eurozone, and in China. At the top line is the global growth, which is estimated at 3% in 2025. That growth is expected to be sustained in 2026 and to remain broadly unchanged in 2027. And this reflects better performance in the US economy, whose growth has been revised upward in 2026 from 2.1 to 2.4, and slightly downward in 2027. The UK growth has also remained. The projection has remained broadly unchanged at 1.3% this year and 1.5%, but the Eurozone area growth has been revised upward slightly. And of course, this growth in these the three areas that I mentioned, the US, the UK, and the Eurozone, have an impact on Kenya's economy through several channels, through exports, through tourism, and through diaspora remittances. So turning to the global financial conditions, these have improved quite significantly, and this is reflected in the chart on the left, which shows the performance of selected stock indices, and you can see all of them are going up. We do have there the Morgan Stanley Capital International for Kenya, which includes about 5 stocks from Kenya, 3 banks and 2 non-banks, and you can see there that it too has been increasing quite significantly. On the right, the Eurobond yields, and again, especially just for the select African countries, and other than Senegal, you can see that there is a downward trend in the yields for Eurobond. And this is good for at least access to capital markets for emerging and developing market economies. So to summarize on global developments and outlook, the global inflation is projected to decline both in 2026 and 2027. And this decline will be led by lower energy prices and because of reduced global demand. For central banks, this continue for the major economies. They will continue to ease monetary policy, but this easing will be based on inflation and growth outlooks. The global growth is expected to remain resilient both in 2026 and 2027, supported by improved prospects in the United States, the Euro area, and also China. The global financial conditions have improved as reflected in the recovery in major equity markets and the decline in yields for Eurobonds. The risk to the global growth outlook remains elevated due to elevated trade policy uncertainty, weak global demand, heightened geopolitical tensions in the Middle East and between Russia and Ukraine. And Kenya's growth is expected to remain above the emerging market and developing economies and the sub-Saharan Africa averages. And this mainly reflects the diversified nature of the Kenyan economy. So turning now to domestic economic developments and the outlook, starting with inflation developments and outlook. This is a snapshot of the rate of inflation from January 2022 to January of 2026. And there you can see the inflation reached a peak of 9.6% and has been trending downward since that time, reflecting the tightening of monetary policy, but also the favorable weather conditions that had a positive impact on on food prices. But so that is the midpoint is there is a 5% where we have the green dotted line, and the upper bound of is 2.5 percentage points above the 5% and 2.5 percentage points below the target. So essentially, it's between 2.5 and 7.5 is our target range. So overall inflation declined in January 2026 from 4.5 the previous month. It's also instructive that inflation since August of 2025, the overall inflation has been around 4.4 to 4.6%. The decline in headline inflation between December and January was the result of a lower core inflation, which decelerated from 11.2% in December to 10.3% in January. And this decline basically more than offset the increase in core inflation, which rose from 2% to 2.2%. The main drivers for the non-core inflation, which resulted in a decline from 11.2 to 10.3, the main drivers were the lower prices of some vegetables, and in particular the tomatoes and onions. And for non-core inflation, essentially we have three components. We have the food component, we have the energy component, and we have the transport component. And from there you can see that the food component, the percentage in the non-core inflation has declined from 9.1 to 7.9%, and that has essentially offset some of the increase in energy and utility inflation, whose contribution rose from 1.2 to 1.4 percentage points between December and January 2026. For the core inflation, the main drivers for core inflation and for this increase that happened between December and January was because of higher prices of some processed food items, and in particular the maize flour. Our projections of inflation in the near term suggest that overall inflation is expected to remain below the midpoint of the target range in the near term, and that this will be supported by stable prices of processed food items and energy, and also because of the stability of the exchange rate. Looking at the private sector expectations about inflation, the January 2026 MPC Market Perceptions Survey, as well as the Agricultural Sector Survey, show that inflation expectations remain firmly anchored within the 5 plus or minus 2.5% target range in the near term. In the case of the Agricultural Sector Survey, and looking at inflation expectations in the next 3 months, 62% of the respondents expect an increase in inflation within the next 3 months, and 38% expect a decline or inflation to remain unchanged in the next 3 months. The agricultural sector respondents to the survey expect the stable pump prices and the exchange rate stability, the favorable weather conditions in the especially from the March to May period to support stable inflation in the near term. However, a majority of respondents expect seasonal factors associated with dry weather conditions before the onset of the long rains in March to exert moderate upward pressure on prices of some food items, and in particular vegetables, and that will also have an impact on the overall inflation. In regards to the banks' expectations of inflation by the banks and the non-bank firms, again the survey, the January survey, showed that inflation expectations in the near term remain anchored within the target range, mainly due to the exchange rate stability, lower global oil prices, and the expected onset of the long rains, which will moderate food prices. The banks' inflation expectation by banks about 4.5% in the next few months, and for the non-banks, it's about it's between 4.5 and 4.57 for both banks and the non-banks. So to summarize on developments and outlook for inflation, the overall inflation has eased to 4.4% in January 2026 from 4.5 the previous month. And the overall inflation is expected to remain below the midpoint target in the near term. And this stability below the midpoint will be supported by stable prices of processed food items, the stable energy prices on account of lower international oil prices, and the stability in the exchange rate. The private sector expectations from the banks, the non-banks, as well as the agricultural sector show that inflation expectations remain firmly anchored within the target range in the near term, and that the risk to this outlook on inflation, the risk will emanate from adverse weather conditions, maybe higher tariffs on trade and geopolitical tensions that could have an impact on oil prices. In regard to GDP growth developments and the outlook, looking at the very bottom row there, we see we are projecting growth for 2025 to come out at 5%. This is a revision downward. Before we had a projection of 5.2%, but given the actual outcome of growth in the third quarter of 4.9%, we revised the growth prospects for 2025 from 5.2 to 5%. Going forward to 2026 and 2027, respectively, we expect growth to increase to 5.5% and 5.6%. And this optimistic view of growth is supported by the agricultural sector growth, which is expected to remain stable at a reasonable growth rate of about 4.5%. And that will be supported by favorable weather conditions, subsidized fertilizer, and expansion in irrigation. The industrial sector also is expected to continue to recover, and this recovery will be driven by construction and the affordable housing program, especially with the settlement of the pending bills. And of course, I should add that we expect the lower interest rates to have a positive impact, not only on the industrial sector, but also the services sector, and that this impact will be felt, it will be a full year effect as opposed to last year. In other words, we expect lower interest rates in 2026 compared to 2025 to have a stimulating impact on not only the agricultural sector, industrial sector, as well as the services sector. The key service sectors are expected to remain resilient, supported by continued digitization of the economy, the expansion of e-commerce, and the easing of cost of credit. The improved uptake of credit across key sectors is expected to support growth, particularly in building and construction, manufacturing, consumer durables, as well as trade. And the recent extension of AGOA will support growth in apparel's exports to the United States. So this is the sectoral growth in credit to the private sector. It's really a demonstration of the transmission of the easing of monetary policy to lower interest rates and ultimately to expansion of credit to the private sector, increased demand of credit from the private sector. Manufacturing, starting with manufacturing, there's been a steady recovery in credit going to the manufacturing sector. There was some slowdown in December and January, but this reflected significant net loan repayments both in December and January, but we do expect that to pick up again in the course shortly. Trade going to the trade sector remains strong. For building and construction remains even stronger and recorded 35%, which is very strong. The consumer durables also credit there remains strong. And of course, in the agricultural sector, you can see a very sharp pickup in credit going to the agricultural sector. And as of January, credit to that sector was increasing by 28.3%. And looking at the expectations from the private sector, and in terms of their prospects, the prospects of growth, particularly in the next 12 months, for banks, on the left-hand side, you can see that those who are optimistic about growth prospects for the next 12 months, 89% expect better performance, and some 3% are very optimistic about growth prospects for the next 12 months. For the non-bank private firms, 75% are very optimistic, and another 10% are very optimistic about growth prospects. Similarly, for the CEOs survey, the 39% of the respondents, of the CEOs respondents, expect higher growth in the next 12 months. Almost 50% expect the prospects to be about the same, and only 11% expect the growth prospects to be lower in the next 12 months. But this, for the CEOs, this is the lowest percentage that expect a lower growth prospect over in the last 2 years. And this optimism was attributed to the stable macroeconomic environment with low inflation and stable exchange rate, lower interest rates, expected favorable weather conditions, increased infrastructure spending, and digital innovations, and improved private sector credit growth. However, some respondents expressed concerns about low consumer demand, high cost of doing business, and increased global uncertainties attributed to the heightened geopolitical tensions and the higher tariffs. So to summarize on domestic economic growth, the economy remained resilient in the third quarter of 2025, and for 2025 we expect a growth of 5%. For 2026 and 2027, we expect growth to pick up to 5.5 and 5.6% respectively. And from the private sector, we see sustained optimism about business activity and economic growth prospects for the next 12 months. And of course, this outlook is subject to risk, including adverse weather conditions and elevated trade policy uncertainties and the geopolitical tensions. On monetary policy developments, this is our monetary policy implementation framework. And this is, we adopted this framework in August of 2023. And the time that we introduce it was to really to enhance the implementation of the framework and for better transmission of the monetary policy decisions. The interest rate corridor, we initially set it at 250 basis points on either side of the CBR, and you can see that from on the left-hand side of the slide. But we have progressively reduced the size of this corridor to 75 basis points. You can see at the end, towards the end there. And of course, as I said earlier at the beginning, we reduced this corridor further to 50 basis points on either side of the CBR. And the whole idea is really to, again, to align more closely the Kesonia, which is our target, and to make sure that that target closely aligns with the policy rate. And again, just to emphasize the improvement in this framework, that when one looks at the Kesonia at the beginning of this slide and compares with the CBR, which is the blue line, there appears not to be much correlation between the two, but over time we have been able to manage this framework and to ensure that Kesonia and the policy rate are very much aligned and with a very high correlation. So with that framework, we have the short-term interest rates and commercial banks lending rates have continued to decline in line with the reduction in the central bank rate. On the left, I've seen the average treasury bill rates have declined from a range of 16 to 17% to a range now of between 7% and just slightly over 9%, 9.2%. On the right-hand side, the average commercial bank interest rates on credit, but also on deposits. Again, we've seen a continuous, although slow, reduction in the lending rates from 17.2% to 14.8%. That's a reduction of 240 basis points as compared to the reduction in average deposit rate from 11.5 to 7, which is a reduction of 450 basis points. So again, from here we do see a lag in the commercial banks reducing their lending rates. On the one hand, the policy rate has gone down by now 425 basis points, including yesterday's decision. They have reduced the average deposit rates for their customers by 450 basis points, but the lending rates have only declined by 240 basis points. And the differential between lending rates and the deposit rates have continued to expand, and it's for this reason that we think that the new risk-based credit pricing model that will be fully implemented in March will address this divergence between the lending rates and the deposit rates. The growth in commercial bank lending to the private sector has continued to improve, reflecting improved demand for credit in line with the lower lending interest rates and resilient economic activity. And there you can see the turnaround in credit to the private sector since January of 2025, when we experienced a reduction in credit to the private sector of 2.9%, and this has gradually improved to 6.4% in January of 2026. Again, this is our risk-based credit pricing model that that is now applicable, particularly for the new loans beginning December. The banks are expected to transition to beginning March 1st, and to transition all the old loans that were taken before December to this new framework. And therefore, with the decision that was taken yesterday by the Monetary Policy Committee, for those borrowers that borrowed their funds beginning December and have a reference rate, either the Kesonia or the CBR, we would expect the banks to lower their lending rates immediately by the 25 basis points that we have reduced the CBR by. So to summarize on monetary developments, Kesonia, the operational target for monetary policy, continues to closely track the CBR. Short-term rates have continued to decline further with the recent reductions in the CBR, and of course reflecting the decline in lending rates. Growth in credit to the private sector has increased from -2.9 to 6.4 in January 2026. Commercial banks' average lending interest rates have continued to decline, although, as I keep emphasizing, this decline is very slow. But this decline has been facilitated by the decline in short-term rates, and this was expected to transmit further into lower lending rates and improve lending to the private sector. On the balance of payments, the current account deficit is projected to remain broadly stable in 26 and 27, and is expected to be more than to be fully financed by the financial account inflows. And looking at line number A, line number B, and line number C, we see for 2025, 2026, and 2027 that the current account will be in deficit of about 3.3 billion in 2025, 3.35 in 2026, and 3.5 in 2027. But that deficit will be more than covered by the financial and capital account, that is line B, which will have a surplus in 2025. We had a surplus of $5.8 billion, and in 2026 a surplus of $3.9 billion, and 2027 a surplus of $3.5 billion. And as a result, we expect overall balance of payment surpluses of 2.3 in 2025, 571 million in 2026, and $18 million in 2027. And that these surpluses will then be used to build our reserve position, and then you can see in line number D, where the reserves increase by the size of the overall balance of payments surplus. The current account deficit is estimated at 2.4% of GDP in 2025, and this is compared to 1.3% of GDP in 2024. This is due to lower service receipts and secondary income transfers as a share of GDP. And the deficit is projected to remain stable in both 2026 and also in 2027. The goods exports increased by 6.1% in 2025 compared to 2024, and this was supported by higher domestic exports of horticulture, coffee, tea, manufactured goods, as well as apparel. Domestic exports increased by 7.9% in 2025, while re-exports were lower by 12.4% in the period, and this was partly due to lower imports of jet fuel, partly attributed to the lower international oil prices. The goods imports increased by 9.1% in 2025 compared to 2024, and again this reflected the largely increased imports of intermediate and also capital goods targeted at domestic production. The services receipts increased by 1.1%, mainly supported by an increase in travel receipts of 8.1%. Tourist arrivals remained resilient in 2025 and increased by 6%, mainly on account of recovery of international travel and government measures to diversify source markets. And we believe that for 2026 and 2027, that arrivals should average about 10%. Remittance inflows remained resilient in 2025 despite increased global uncertainties, supported by diversified source countries and the impact of government policies to export skilled labor. There was a slowdown in growth of remittances in 2025 to 1.9%. This compared to 18% the previous year, but the slowdown we expect that the slowdown in 2025 will reverse. There were some changes in the labor laws or practices in Saudi Arabia. Saudi Arabia had become one of our largest source of remittances. But with the change in those labor policies, there has been a slowdown in remittances from there. And we did see a reduction in remittances by 25% from Saudi Arabia. We expect that this will not be permanent and that therefore there will be some recovery in 2026. And that's why we have an increase in growth of remittances by 4% in 2026 and 5% in 2027. The foreign exchange reserves, as I've just explained, from the overall balance of payment surpluses, these reserves have increased and continue to provide adequate cover and a buffer against short-term shocks. As of February, we had reserves of almost $12.5 billion, and this is equivalent to 5.4 months of import cover. The Kenyan shilling has remained stable, supported by diversified foreign exchange inflows, increased confidence in the economy, and the build-up in foreign exchange reserves, and the recent upgrade of Kenya's credit rating by Moody's ratings agency has boosted investor confidence. Looking at the private sector expectations about the exchange rate, we see that most respondents, 84% of the banks and 81% of the non-banks respondents expect the exchange rate of the Kenyan shilling against the US dollar to remain stable or strengthen in the next 2 months, and this will be supported by sufficient foreign exchange reserves, which are expected to provide a buffer against shocks, and improved foreign exchange inflows from exports, tourism receipts, and diaspora remittances. Some respondents expect some moderate pressure on the exchange rate arising from increased import demand. So a quick summary on the balance of payments development and outlook. The current account widened in 2025 to 2.4% of GDP. The current account deficit is projected to stabilize at about 2.2% in both 2026 and 2027. This would reflect continued growth in goods imports, increased exports growth, and moderate growth in diaspora remittances inflow. But as I indicated, the current account deficits will be more than financed by financial account inflows in both years, 26 and 27, and that this should result in overall surpluses, which will help us build further our international reserves, which are projected at almost 13 billion at the end of 2026 from 12.394 billion in 2025. The downside risk to the balance of payments outlook, escalation of geopolitical tensions, persistent elevated trade policy uncertainty, and volatility in international oil prices. Turning to the banking sector, the banking sector remains stable and resilient. The capital adequacy and liquidity ratios for the banking sector have remained above the minimum statutory limits of 14.5% and 20% respectively. The total capital adequacy ratio stood at 20% in December of 2025, up from 19.9% in October of 2025. The average banking sector liquidity ratio was 59.3% in December 2025, up from 59% in October of 2025. The ratio of gross non-performing loans to gross loans decreased to 15.5% in January of 2026, and this is compared to 16.7% in October and 17.6% in August of 2025. Banks have continued to make adequate provisions for the NPLs, and the sector remains profitable, providing sufficient buffers. The revised banking sector risk-based credit pricing model, which will be fully operational in March of 2026, should improve the transmission of monetary policy decisions to commercial banks lending interest rates and enhance transparency in the pricing of loans by banks. In regard to fiscal developments and outlook, we have presented here the budget for 25-26. The budget that was submitted to Parliament had a deficit of 4.7%. That is what is depicted here. We know the Treasury is working on the supplementary budget for 25-26, and we expect also shortly to know what the budget for 26-27 is, and what the deficit for 26-27 will be. But essentially, the government still plans to have fiscal consolidation over the medium term in order to reduce these debt vulnerabilities and move the country to a sustainable debt position and towards our debt anchor of 55% of the net present value of debt to GDP by 2030. So to summarize, and the key takeaways, on the global front, inflation is expected to decline both in 26, 27, driven by lower energy prices and reduced demand. Global growth is also expected to remain resilient in 2026 and also in 2027. On the domestic front, overall inflation remains firmly anchored within the target range. The Kenya shilling has remained stable. Economic growth has remained resilient, anchored on macroeconomic stability. Interest rates have continued to decline, which should continue to support growth in credit to the private sector and improve economic growth prospects. The monetary policy implementation framework has enhanced policy transmission and aligned the Kesonia closer to the central bank rate. The banking sector remains stable and resilient, and confidence in the economy remains strong, particularly with the recent upgrade of Kenya's credit rating by Moody's. And in view of the stability in prices and the exchange rate that has been achieved thus far, the CBK has continued to support the government's economic growth objective, as reflected in the further reduction of the CBR. So thank you very much.
Thank you. That was the governor of the Central Bank of Kenya, who's also the chair of the Monetary Policy Committee. So we'll go straight into the questions that have been sent in. And as we said, there are some questions, obviously, that we'll be combining in case they're asking about the same issue. Begin with George Obulutsa from Reuters. George is asking, what proportion of official forex reserves is in yuan, and what are you doing to boost that after Chinese loan conversions? He then swivels to the question on the IMF, and he asks, how assured are you of a new IMF program? Julian Zamboko from NTV is also on the IMF. He says, is there an update on the Article 4 discussions? And he says, I understand that an IMF mission should be in town this month. Mwana Njuguna, who is an editor at kenyas.co.ke, he talks about global forecasts pricing the shilling weakening to 135 to 150 by year end. What is CBK's projection and how confident are you?
Yes, thank you. Let me deal with the issue of the IMF first. Yes, indeed, we are expecting a staff visit from the IMF later on this month, and should cover the Article 4 discussions, as well as discussions on IMF-supported program. On the issue of what portion of our forex reserves is in yuan, we don't have. It's not a very large portion. We do have some, but we don't think that is a hindrance or that constrains our ability to make any payments on the Chinese loans. Normally conversion from dollars to any currency is quite straightforward and quite that's normal practice in a sense. On the exchange rate, I think of course we don't have a specific projection for the exchange rate. And I think what I've tried to demonstrate is that there are quite a significant amount of inflows coming into the economy. I've described how the balance of payments was in surplus last year. Is expected to experience another surplus this year and also next year. So we don't expect pressures on the exchange rate, and therefore we do expect the stability of the exchange rate to continue for the rest of the year.
Charles Moneki from the Business Daily is asking, were there any banks that failed to meet the 3 billion shilling core capital requirement by the 31st of December? And if any, what action has been taken against them? Jimmy Mbogo from CTV, that is Citizen Television, asks, despite the cuts, banks are still charging an average of 16 to 17%. What will the central bank do to ensure that borrowers enjoy a reduction in lending rates? Julian Zamboko from NTV, 10 consecutive cuts later, how has the output gap evolved since the start of this cutting cycle? And he continues, is it still deep in negative territory? And related to the MPC decision, Ramanyang from CGTN is asking, private sector credit growth is still in single digits. Are banks still reluctant to lend given the high and sticky non-performing loans levels, or is credit demand still weak?
Yeah, let me start with Charles Moneki. I think most banks met the 3 billion. There are some that will meet the 3 billion mark because of merger by March. So we expect by March all the banks to have met the 3 billion target that we had for core capital, and then to start off on meeting the 5 billion target for this year. On Jimmy Bogo's question on despite the cuts, banks are still charging a high interest rate. And what are we doing to ensure that borrowers are enjoying the lower lending rates? And this is exactly what we have been trying to do by introducing this new risk-based credit pricing model, which is to ensure that all the banks have a common reference rate, and that reference rate is linked to the policy rate, the CBR, so that when we lower the CBR, there is also a proportionate or even a one-for-one reduction in interest rates. Julian's asked about yes, these are 10 consecutive cuts in the CBR rate, in the policy rate, and whether the output gap is still in deep negative territory. Certainly it's not in deep negative territory, but there's still some output gap, and that's why we are still confident that we can still lower the policy rate and lower credit interest rate on credit without, in a way that is non-inflationary, given that we are still far away from the potential growth of the economy. There's still a small gap, output gap, but it's possible we are approaching the point where the interest rate, the neutral part of interest rate. But right now, it's still in negative territory, not deep, but still in a bit of a negative territory. And I think that gives us a little bit more policy space to be able to lower interest rates. Ramanyang, I think your question on private sector credit growth is still single digits. And whether banks are reluctant to lend. I think certainly maybe there's still credit demand is still somewhat weak. I do agree with you. The plan, we would be planning to have credit to the private sector expand at least double digits, or at least above 10%. And that's what we are aiming at. By continuing to ease monetary policy, we expect that to translate to lower lending rates by the banks and to have more credit expansion to the private sector to encourage credit demand from the private sector. And as I was just in response to Julian's question, I think we are able to do this without concerns about destabilizing the achievements that we have on the inflation front, but also on the stability of the exchange rate. So we are doing it in a measured way, but without undoing the achievements that we have on the stability of the inflation as well as the exchange rate.
So the final batch, we begin with Jimmy Mbogo from Citizen again. Should you expect more mergers and acquisitions in the banking sector? If so, how many are you looking at and how soon? Andrew Maina from Gamani Consulting says, with a healthy balance of forex reserves at 5.4 months, which is pretty astounding and it's a great job, do we anticipate going into the purchase of gold as an extra buffer? And finally, Stella Swake from Kingdom Securities, who says, who asks rather, how does continued mopping up of liquidity by the central bank align with the need to stimulate further private sector lending?
I think on Jimmy Mbogo's, we certainly welcome any mergers and acquisition in the banking sector. As we've said, the stronger the banks, the more competition, the more they can provide credit on a large basis. Do we have any? Are we looking at any, and how soon? We are not aware of any mergers that are not public already, but we welcome any mergers going forward. Andrew Mina's observation is we have a healthy balance of forex reserves at 4.5 months, and we anticipate going into the purchase of gold as an extra buffer. This is something that we have indicated before. It is one of ways of diversifying our holding of reserves, and as I've said in the past, it is something that we are actively looking at. On the Stella Swake, how does continued mopping of liquidity by CBK align with the need to stimulate further private sector lending? Again, Stella, what I would say is we have an inflation targeting framework. And under that framework, our operating target is the Kessonia. So what we then try to do is ensure that that Kessonia is aligned to the policy rate. And that's why we now intervene by mopping up liquidity if we think that the liquidity that is there is going to result in a wedge between the Kessonia and the policy rate. The policy rate we now have should be consistent with maintaining price stability, but we also expect that reduction in the policy rate to translate into lower lending rates by the commercial banks.
So thank you. That brings us to the end of this post-MPC press briefing. This is obviously after the February MPC, and we expect another Monetary Policy Committee meeting in April, which is 2 months from now. So until then, do have yourselves a good time.